Hey everyone, welcome back to the channel. Today, we're diving into a story that's been making some serious waves in the financial world, but might not have hit your mainstream news feed just yet. We're talking about Japan and a very interesting move it just made with US Treasury bonds. The latest data from the US Treasury Department shows that in April, Japan sold a staggering $37.5 billion worth of US Treasury securities. Now, that's a huge number, and it naturally begs the question, what's going on here? Is this the start of a major financial shift, or is there more to the story? Let's break it down. First, let's get some context. Japan has long been one of the largest foreign holders of US debt. For decades, they've been a reliable, steady buyer of our bonds. This relationship has been mutually beneficial. For the U.S., it means a stable source of funding for government spending. For Japan, U.S. Treasuries have been a safe, reliable place to park their massive foreign exchange reserves, earning a steady, albeit sometimes low, interest rate. This financial relationship is a cornerstone of the economic alliance between the two countries. So, when Japan starts selling off billions, it's not just a random transaction, it's a move that gets analysts and economists sitting up and paying attention. So, why the big sale? The primary driver behind this move seems to be the currency market, specifically the struggle of the Japanese yen. For months now, the yen has been incredibly weak against the US dollar. It even hit a 34-year low, dropping past the 160 yen to the dollar mark. For a country like Japan, which relies heavily on imports for things like energy and food, a weak currency is a huge problem. It makes everything they buy from overseas more expensive, which fuels inflation and puts a squeeze on household budgets and businesses. Imagine your grocery bill and gas prices shooting up month after month. That's the reality for many in Japan right now. The Japanese government and the Bank of Japan can't just sit back and watch this happen. They have to defend their currency. One of the most direct ways to do this is through what's called currency intervention. This is when a central bank steps in and uses its foreign currency reserves to buy its own currency on the open market. In this case, the Bank of Japan would sell US dollars and buy Japanese yen. This increased demand for the yen helps to push its value up, or at least stop it from falling further. But where do they get all those US dollars to sell? This is where the US Treasury bonds come into play. A country's foreign exchange reserves aren't just a giant pile of cash. A huge portion of them is held in the form of assets, and for Japan, US Treasuries are the biggest and most liquid asset they have. So, to get the dollars needed for intervention, they need to sell some of those bonds. Think of it like this: you need cash for an emergency, so you sell some of your stocks or other investments to raise the money. That's essentially what Japan is doing on a massive, international scale. They are liquidating a portion of their safest assets to handle a pressing economic problem at home. The numbers seem to support this theory. The suspected interventions by Japanese authorities happened at the end of April and the beginning of May. The Treasury data for April shows this huge $37.5 billion sale. It's a classic case of connecting the dots. Japan needed dollars to prop up the yen, and to get those dollars, they sold US Treasuries. It's the most logical and direct explanation for this significant move. Now, a lot of people hear dumping US debt and immediately think the sky is falling. They worry it means a loss of confidence in the US economy, that the dollar is about to collapse, and that this is the beginning of the end for America's financial dominance. While it's always wise to be vigilant, in this specific case, that's probably an overreaction. This move by Japan appears to be driven by its own domestic policy needs, not by a sudden panic about the stability of the U.S. government or its ability to pay its debts. They aren't selling because they think U.S. bonds are a bad investment. They're selling because they need the cash for a different, more urgent purpose. Let's also look at the bigger picture of who holds US debt. While Japan's sale is significant, they still hold over $1.1 trillion in US Treasuries. They remain the largest foreign creditor to the United States. A single month sale, even a large one, doesn't erase that fact. It's more like a portfolio adjustment than a complete abandonment. Another major player is China, the second largest foreign holder. Interestingly, China has also been gradually reducing its holdings of U.S. debt over the past few years. Their reasons are more complex, tied into geopolitical tensions, a desire to diversify their reserves, and efforts to internationalize their own currency, the yuan. But even with their selling, the global demand for U.S. Treasuries remains incredibly high. Why? Because in a world full of economic and political uncertainty, U.S. Treasury bonds are still seen as the ultimate safe haven asset. They are backed by the full faith and credit of the world's largest economy. When there's a crisis anywhere in the world, money floods into U.S. Treasuries, not out of them. So, should the U.S. be concerned at all? Well, yes and no. On one hand, this move by Japan highlights a potential vulnerability. The U.S. relies on foreign countries to help finance its massive and growing national debt. If major holders like Japan and China were to start selling off their bonds aggressively and simultaneously, it could cause problems. It would push U.S. interest rates up, making it more expensive for the government to borrow money. That could have knock-on effects for the entire economy, affecting everything from mortgage rates to business loans. It would signal a major shift in global financial power. However, the likelihood of a coordinated, large-scale dump is extremely low. It wouldn't be in Japan's or China's best interest either. A sudden sell-off would crash the value of the very bonds they still hold, meaning they would be shooting themselves in the foot. Their remaining trillions of dollars in U.S. debt would become worth much less. It's a classic case of mutually assured financial destruction. Therefore, any reduction in their holdings is likely to be gradual and carefully managed, not a sudden, panic-fire sale. What this situation really underscores is the incredible interconnectedness of the global financial system. A decision made in Tokyo to support the yen has a direct impact on the U.S. bond market. Economic policy in Washington, particularly the Federal Reserve's decisions on interest rates, has a massive effect on the value of the Japanese yen. It's a complex web where every action has a reaction. The Fed raising interest rates made the dollar stronger, which in turn weakened the yen, which then forced Japan to sell U.S. bonds. It's a chain reaction. Looking ahead, what can we expect? Japan's currency troubles are far from over. As long as there's a wide gap between U.S. interest rates and Japanese interest rates, the yen will remain under pressure. This means we could very well see more interventions and, consequently, more sales of U.S. Treasury bonds by Japan in the coming months. We'll be watching the upcoming Treasury data for May very closely to see if this trend continues. If Japan keeps selling, it will add to a growing narrative about the changing landscape of global finance. But for now, the key takeaway is to look beyond the sensational headlines. Japan isn't dumping U.S. debt out of spite or fear. They are using their financial toolkit to manage a serious domestic economic challenge. It's a strategic move, born out of necessity. While it serves as a reminder that America's reliance on foreign financing isn't without its risks, the foundation of the U.S. dollar and the Treasury market remains solid for the foreseeable future. The world still runs on dollars, and when push comes to shove, everyone still wants the safety and liquidity that U.S. bonds provide. This is a developing story, and it's one we'll continue to follow right here on the channel. It touches on so many important themes: currency wars, central bank policy, national debt, and the shifting plates of global economic power. What do you think about Japan's move? Is it a smart strategy to defend the yen, or a risky gamble? Let me know your thoughts down in the comments section. I always enjoy reading your perspectives and getting a discussion going. Thanks so much for watching today. If you found this breakdown helpful and want to stay informed on these kinds of global financial stories, make sure to hit that like button and subscribe to the channel so you don't miss our future updates. We'll see you in the next video.